So we listen to a lot of investing podcasts, Shani. We read a lot of investing content, and you're always hearing about what investors have in their portfolios.
And we've covered this before and talked about how we think they are generally unhelpful, with some context including the goals and strategy of the investor that holds them. But today we're doing something a little different. We're going to talk about things that are not in your portfolio, Mark.
Right. And you want to go through all the jokes, like any winners?
Oh, in your portfolio.
Yeah.
Okay.
Anyway.
Wasn't very good. So
we're going to do large categories, though. We're obviously not going to do individual securities, large categories.
Okay. Well, I'm glad we're focusing on large categories. We should do another episode where I just go through the ASX 300 and you say yes or no.
Do you think people would enjoy that?
Compliance wouldn't, but...
What would we title it? Like Kermit reads 300 company names?
Yeah, I could just take the day off.
There we go. Well, luckily for you and our audience, we're not going to do that. Shani will be very much part of this episode. We're going to do a couple disclaimers. I'll do a couple disclaimers that I will probably repeat multiple times as we go through this. But the things that are not in my portfolio are based on my own personal circumstances. That includes my investment strategy, my temperament, my overall financial position. Just because I wouldn't buy something now doesn't mean that I wouldn't in the future as I get older and my circumstances change.
All right, so let's get into it. As much as everybody likes disclaimers, the reason we think this exercise is helpful is because as investors, we do have an abundance of choice. Some, including us, would consider this an overabundance of choice. With all these different options out there, the product providers have to work extra hard to sell them. And that means more niche products, and it means more marketing, and it means more appealing to our base emotions. So this all means that eliminating large categories makes your life a lot easier as an investor.
Yeah, and the issue is that with all these choices and these slick marketing campaigns, investors are constantly tempted to switch investments. And there's been a huge increase in trading and turnover in people's portfolios. And as you've heard multiple times on here, that generally does not work out well for investors.
And we all need to remember that our financial outcomes are likely more of a result of what we choose not to buy than what we choose to buy.
Well, that's like very profound, Shani. I know. I found a quote, though. So Barry Schwartz, he was made famous he wrote the book, A Paradox of Choice. He said, learning to choose is hard, learning to choose well is harder, and learning to choose well in a world of unlimited possibilities is harder still, perhaps too hard.
All right, so why don't we move on to your first category, Mark, of what you don't invest in?
Bonds. That's not enough.
Yeah, you're really starting out with a niche part of the investing universe where we have, 60-40 portfolio.
Yeah, and it's like the bond market's much bigger than the stock market. Yeah. So it's actually, I've eliminated most of what's out there.
So it leaves you with shares and cash. But you should probably explain why you've eliminated bonds.
Okay, so there are 4 reasons that I don't invest in bonds. I will get to those in a second. But they're all based on 3 very important facts, and they're facts about me. So this is like Mark Trivia, something that nobody wants to play. First, I'm 45, and despite what Shani says, I still have a fairly long time until retirement. So that's fact 1. Fact 2, I think there's a pretty low probability that I will panic during a market downturn. And I'm saying that because I didn't panic during these other market downturns in my life. So at least there's some sort of evidence there.
Do you know, I was going to ask you, what do you panic over? And then I realized I had an answer to your question. Do you remember during COVID where we were in lockdown and I sent you a message because it was going around on social media that the liquor stores are closing down?
Oh, I spent like $4,000. I just take like 8 trips back from the, yeah. and then of course it wasn't true.
No, but you were very well stocked.
Well, it was COVID. What else are you supposed to do?
Yeah.
Like you didn't drink during COVID. All right. Fact 3. So that is what I panic over. Fact 3 is that my portfolio is mostly invested in shares, but as Shani likes to point out, I am a boring guy. I'm an income investor. I own boring shares. They pay dividends. They're generally big multinational companies. They skew towards non-cyclical industries like consumer defensive and infrastructure companies and healthcare. So traditionally, my portfolio has been a lot less volatile than the market. So those are the three facts about me. A bonus fact about me during COVID. So I guess now we can go through those 4 reasons I don't own bonds.
I feel like you're building a lot of suspense here. And bonds are really boring, so this is good.
Yeah.
Keep going.
Yeah, exactly. Okay. So here are my 4 reasons for not owning bonds. So volatility is not how most investors should think about risk over the long term. The real risk is not earning a high enough real or inflation-adjusted return to meet your goal. So that's 1. Number 2, the trade-off for getting lower volatility is meaningfully lower long-term returns. So this significantly impacts that risk of not achieving your goal. 3, bonds lower volatility but have significantly higher inflation risk when compared to shares. The risk of inflation destroying the purchasing power of your portfolios is one of the biggest risks that I face and likely you face as an investor. 4, while volatility is not a risk most long-term investors face, it does cause people to make bad decisions, which of course I pointed out. I don't think that's going to happen to me, but we do need to remember that that does impact long-term returns.
So let's dive into some of those points that you made. And each of those points mentioned volatility. And as you said, bonds lower volatility, but they don't eliminate it. Bonds still exhibit volatility, but it's just less than shares. Sometimes bonds are negatively correlated to shares, meaning their price moves in the opposite direction as share prices. Sometimes they're positively correlated, which means they move in the same direction. It all depends on the economic environment, but bonds still go down in price. The recent environment in the last couple of years of increasing interest rates is illustrative of this risk. So my question for you, Mark, is this. You've said you don't really care about volatility too much, but do you care at all?
Well, Shani, I do a little bit because, of course, I need cash sometimes. And there may, of course, be unexpected situations that come up where I need cash. Because let's face it, every time I open my mouth, Shani, as you tell me, I get a little bit closer to losing my job. But there's one asset that, of course, has no volatility, and that is cash. So if you put $100 in the bank, then it will be there when you want to get it out, and it will grow. The growth will be less than bonds, but I think we have to put that within context. So over the past 30 years, cash has delivered returns of 4.2% a year, according to Vanguard. Now, bonds have grown 5.5% a year. Those are Aussie bonds. And like bonds, inflation, of course, is a large risk to holding cash. It may not have volatility, but the money you put in the bank will also lose purchasing power over time. So if we take inflation into account, over the last 30 years, cash has delivered real returns of 1.5% a year versus 2.8% a year for bonds. So inflation, of course, is a risk to achieving my goals. It's an outsized risk to both bonds and cash. I still think cash is preferable in a period of high inflation. Higher inflation and higher interest rates cause bond prices to go down. Cash held in a savings account or shorter-term term deposit does not go down in value and adjust to the higher interest rates quicker. So I could buy short-term bonds either individually or in an ETF. However, in an upward-sloping yield curve, so that means longer-term bonds have higher interest rates than shorter-term bonds, I just don't think that trade-off is worth it. So the beauty of cash, of course, is that you can reduce volatility in your portfolio by the same amount as holding bonds, but you need less cash. So that means you can hold more shares. So that was a long rant, as you would describe it. But I just feel like cash works better for my needs.
All right, so one trade-off between cash and bonds is reinvestment risk. Your cash can, of course, sit in a savings account, or if you want, you can get a term deposit for a couple of years. But the issue, of course, is that when the term deposit matures, you have to reinvest at the prevailing interest rate. Now, with a bond, you can, of course, go longer term, which means you can lock in a rate for longer. So does this trade-off worry you, Mark?
No.
All right, turn off the mics.
It's over.
Like, do you want to expand on that?
Exactly. I mean, I think how you access bonds matter. There are ways that you can go out there and buy individual bonds, but most people buy bonds using an ETF or a fund. So let's say I buy a longer term bond ETF. You still face reinvestment risk because a bond ETF, of course, is a portfolio of bonds. There is no maturity date on an ETF. So some bonds will mature in that portfolio. They'll get reinvested at whatever the prevailing interest rate will be. The point is that scenario that you just described with reinvestment risk doesn't apply to ETFs or funds that hold bonds.
So I'm going to play devil's advocate here a bit.
Which you love doing.
I do.
You love pointing out, if I ever send a Teams message to Shani and I spell something wrong, she immediately just corrects that word and sends it back.
Yeah. Do you not like that? Is that annoying?
I've been complaining about it for like 4 years
Okay.
now.
I hear a lot of people say that they'd never invest in bonds, and I can't help but think that's based on the current market environment. So I went back and looked at what the S&P 500 did over the last 15 years. And we're talking US dollar returns here. So I removed any impact for an Aussie investor of currency changes. So that 15-year return is 13.5% a year, which is really high. So do you think people have been lulled into this false sense of security by those returns?
Oh, like absolutely. I think most people that say that they won't invest in bonds probably aren't that thoughtful about it. I think they aren't thoughtful about what their actual reaction will be during a bear market, because it is easy to say you won't sell, but of course it's much harder to do in real life. So if you haven't been through a bear market, and a real bear market, I'm not counting the COVID thing, we blinked and that thing was over, one of those long grinding bear markets like the GFC, for example, I think that you need to acknowledge that you don't know how you'll react. And the second thing I guess I would say is, I'm personally, maybe I'm just very negative, but I'm personally ready and fully prepared for lower returns. So, as I've talked about on here, I am more concerned about income generated from my portfolio right now, so I can take a period of lower returns.
All right, I'm going to call time on the discussion of bonds.
Okay, because you declared them boring.
Yeah.
And we don't want to keep to that. Okay. So the next thing you're probably going to disagree with me about, I don't invest in actively managed funds and ETFs. So let me come up with my rationale before you object. But part of developing an investment strategy, as we talk about a lot on here, is thinking about your edge or your competitive advantage over other investors. And this informs the approach you take and the types of investments that you consider for your portfolio. And I think one of my personal sources of edge is structural. So do you want to explain structural edge?
Yeah, so structural edge refers to the external factors that influence the way an investor acts. This is largely an issue for professional investors. And there are lots of factors that influence professionals. So there's career considerations, dealing with investor inflows and outflows, and pressure to not let short-term performance dip below an index. So none of these issues impact individual investors.
Yeah, exactly. And so I can just focus on the long term and my objectives. And structural edge is something that impacts the average active manager, which is one reason that there's such high turnover in those portfolios. And this is, of course, a generalization. However, active managers also charge higher fees, which detract from the income generated, which, of course, is my goal for investing. That high turnover generates poor tax outcomes compared to passive products. Also a bit of a generalization, but mostly true. And of course, there's no full disclosure of holdings, so it's very hard for me to find managers that are adhering to my standards. So when you combine all of this with the fact that most active managers underperform, it's enough for me to exclude active management. So people may disagree, including you, Shani, but I'm okay with that because I don't believe this decision will impact my ability to achieve my goals.
So you've annoyed people that invest in bonds and active managers. Is your ultimate enemy an active bond manager?
I mean, it's like the supervillain.
Yes.
I mean, maybe. But we have more groups we can go after. Not that I think anyone out there cares what I don't buy. So
we'll see how many people listen to this podcast.
Yeah, at this rate, it might be pretty few. Maybe some people will start, but then that long bond discussion drove most of them away.
Okay, who are you going to annoy next?
Growth investors. So I don't own shares that don't pay dividends.
So before you start, I want to point out that this really isn't true. Do you remember the Christmas gift that you bought me?
Of course I do, Shani.
Sign Joy Holdings, SJ.
SJ.
That doesn't pay a dividend.
That's true. And for long-term listeners, I, of course, remember this. For people that have listened, we do exchange Christmas gifts for each other, to each other. And I bought that stock for Shani because the ticker symbol is SJ, which, of course, are Shani's initials. And sometimes when you want to do something for somebody, you do something you wouldn't normally do. Do you agree with that?
That's true. It's like when Warren Buffett paid that one dividend to Berkshire Hathaway.
Yeah.
And he said he was in the bathroom when they decided that.
You know what another example is? Jack Bogle.
Yeah.
Captain Passive Investing. His son works at an actively managed fund and he invested in that because he's like,
it's my son.
Yeah. What am I going to do? You ordered a fish once and you don't really like seafood. Do you remember we went to that Sri Lankan?
Oh, yeah.
We went to that Sri Lankan glebe.
Yes.
And you ordered it was very early in our friendship. You ordered every dish on the menu because you're excited.
You had to try everything.
And you wanted me to try everything. And so I'm stuffed by the end of this thing. And then the waiter comes over with a whole fish. I don't remember what that dish was, but I did remember that I had to eat it.
You did. You did well.
I try. So should we get back to these non-dividend?
Yeah, tell me about the non-dividend paying shares.
Okay. Well, first of all, I obviously want to start out and say there's nothing wrong with shares that don't pay dividends. Many people point out to me when I make that statement that they ask me if I'm going to miss out on shares that are going to have great performances. And the answer, of course, is yes. My guess is that I'll miss out on the top performing shares over the next 20 years. That would be my guess. So I acknowledge all of that. I only invest in shares that pay dividends because, of course, I've talked about before how I spend some of the income from my portfolio for things I want to do now. That's, of course, a fine reason to pick a dividend-paying share, but it's only part of the reason. I also only invest in dividend-paying shares because that is the investing approach that resonates with me. That's the approach that I know I'll stick with over the long run. I know that investing in dividend shares is the right approach for me just because I know myself. And the secret to investing is, of course, time in the market and consistency. And that's how I do it.
Now, I'm really surprised that we've missed a few things from this list. And I think a big one is crypto.
Okay, well, I pissed everyone else off. I don't want to piss Will off. And honestly, after what crypto's done last year, it's going to be another old man rant about crypto while all the people owning crypto are just counting their money. So we can't do that, right? So I did leave that off. But I thought 3 were enough. We're going to do one with you sometime. Things Shani does not own. Something to look forward to. But anyway, thank you guys very much for listening. Really, really appreciate it. If anyone has any questions or wants to ask Shani what she doesn't own, send me an email. My email address is in the show notes. And we really appreciate you taking the time to listen.
This video has been prepared for clients of Morningstar Australasia Pty Ltd and or New Zealand wholesale clients of Morningstar Research Ltd. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.